Picture this scenario. You're lying awake at 3 in the morning staring at the ceiling, and your mind is racing through the endless noise of the modern financial world. You open your phone, look at a stock chart, and see a company that has added trillions of dollars in value in what feels like a blink of an eye. Sound familiar? Most of us have been there. That strange mix of awe and anxiety where you feel like a historic economic revolution is happening right in front of you, and you're just standing on the sidelines watching it pass you by. Well, what if I told you there's a specific fundamental reality that explains this entire phenomenon, and it has absolutely nothing to do with the speculative hype you hear about on the news? Most people think massive stock market winners are just arbitrary bubbles driven by memes and reckless retail investors who don't know any better. They assume that because a price went up so fast, it must be an irrational mania destined to crash back to earth. But here's something that might surprise you. There's actual mathematics, engineering, and long-term strategy behind why this specific company managed to capture the entire world's capital. And the real game changer isn't just that they make fast hardware, it's something much deeper. I spend way too much time thinking about market history, technological shifts, and why certain companies manage to completely dominate an industry while their competitors are left scrambling for scraps. If you've ever wondered what it actually takes to maintain a monopoly in the modern tech landscape, and more importantly, how this single stock changes the entire calculus of global investing, this is for you. Now, before we dive into what makes this company so unique, let me paint you a picture of what the tech industry looked like before this explosion. You know that feeling when you look back at historical events like the internet boom of the late 90s or the mobile smartphone revolution of the late 2000s, and you think to yourself, if only I had been paying attention back then? That is the reality for millions of investors right now. Every time a new technological wave hits, the natural instinct is to try and guess which consumer app is going to win. People try to guess which website, which smartphone app, or which artificial intelligence chatbot will become the dominant player. But playing that game is exhausting and incredibly risky. You're constantly guessing instead of being able to rely on foundational, structural certainties. But here's where things get interesting. There's a specific operational strategy that this company executed over the last 20 years that completely insulates them from that guessing game, and it has nothing to do with just selling chips to video game enthusiasts. In fact, the general public completely missed this transition while it was happening. The real transformation was much more subtle and much more powerful. The first thing that changes when you look under the hood is your understanding of competition. When people think about tech hardware, they assume it's a standard race where whoever makes the fastest product wins. But this company realized early on that hardware is just one piece of the puzzle. They built an entire proprietary software ecosystem that acts as the universal language for accelerated computing. Imagine building a revolutionary train, but before anyone else can even think about competing with you, you've already laid down every mile of railroad track across the continent and trained every engineer in the world how to use it. That software layer is the ultimate safety net. It doesn't mean competitors can't build good hardware, but it gives developers permission to ignore the competition because the switching costs are simply too high to justify. There's also something fascinating that happens to investor psychology when a stock reaches these unprecedented heights. Financial analysts find that extreme price appreciation creates a unique form of market paralysis. This means that looking at the chart doesn't just inform you, it literally changes your tolerance for risk. Think about the last time you saw a stock double or triple in a single year. Your immediate reaction is usually panic. You're stressed about whether you should buy now out of a fear of missing out or whether you should wait for a pullback that might never come. But when you understand the fundamental engine driving this growth, that anxiety turns into clear-eyed analysis. You realize that while individual software companies might fail, the underlying demand for the infrastructure itself remains relentless. This shift from speculation to understanding structural demand might seem small, but it has ripple effects throughout your entire investment philosophy. When you're not constantly chasing the next shiny object, you make better decisions in general. You stop trying to day trade the daily volatility and start focusing on the macro shifts that actually rewrite the global economy. But here's something that most people don't realize about this technological milestone. The majority of the value doesn't come from the individual chips being sold today. It comes from the compounding network effects of the entire platform. This is what industry experts call the infrastructure effect, and it's probably one of the most underrated concepts in modern business. A dominant tech ecosystem isn't just about protecting your current market share, it's about the compounding leverage that comes from knowing the entire industry is building on top of your foundation. Most tech companies spend their resources defending against immediate threats. This company spends its resources scaling into future opportunities that their competitors haven't even conceived yet. There's also a scale factor that's hard to quantify but impossible to ignore. When a company has this level of free cash flow and market dominance, they carry themselves differently. They negotiate better with suppliers. They attract the absolute best engineering talent in the world because everyone wants to work on the technological frontier. This confidence and capital advantage often leads to better supply chain security, faster innovation cycles, and better long-term outcomes in general. Now, you might be thinking that trying to evaluate a stock at this scale sounds like an impossible task, especially if you don't have a degree in computer science or advanced electrical engineering. But here's what's interesting about market psychology. The hardest part isn't understanding the technology itself. The hardest part is developing the discipline to tune out the daily noise. Most people approach investing in high-growth tech like it's a temporary lottery ticket. They watch the price action every 5 minutes, get consumed by the daily headlines, and then burn out and sell at the worst possible time. The people who successfully navigate these massive market cycles don't think of investing as a short-term gamble. They think of it as allocating capital to the structural trends shaping the future. This perspective shift is crucial because it affects every decision you make during a market correction. When you see yourself as a part owner of the foundational infrastructure of the digital age, you start noticing the difference between short-term noise and long-term fundamentals. You become more analytical. You start thinking in decades instead of just focusing on the next quarterly earnings report. The beautiful thing about this process is that it gets easier as you build your financial literacy. Analyzing your first hyper-growth stock is brutal. It requires rewriting how you think about valuation, growth rates, and market caps. But understanding your second or third major tech shift is noticeably easier because you've already developed the frameworks and the mental models. By the time you're looking at the broader macroeconomic picture, the process feels almost automatic. There's also a mathematical reality that makes this specific position particularly powerful. The amount of capital required to build a competing ecosystem from scratch is now so massive that it creates a natural barrier to entry. Research and development budgets, global supply chain agreements, software developer ecosystems, most of these things cannot simply be bought overnight, no matter how much cash a competitor has. This means that once a platform reaches this level of scale, it is effectively insulated from the standard competitive forces that derail ordinary businesses. But perhaps the most significant change that happens is how you start thinking about technology itself. Instead of viewing computing power as something that just exists quietly inside your devices, you start seeing it as a finite, highly valuable commodity. Before this revolution, compute power felt abundant and cheap. Every year, chips got faster and cheaper, and we took it for granted. But when you look at the demands of modern artificial intelligence, you begin to understand that high-performance compute is actually the new oil of the global economy. This is where serious investors start getting interested in concepts like data center power grids, semiconductor supply chains, and advanced chip packaging. Not because they suddenly became engineers, but because they finally have the framework to look at the entire value chain. When you're not constantly worried about the daily stock price, you can start wondering about the physical constraints of global electricity grids. When you're not stressed about short-term market pullbacks, you can start researching the long-term roadmap of next-generation computing architectures. Consider this. A company that controls the core infrastructure of an industry is fundamentally more resilient than the companies trying to build consumer products on top of it, even if those consumer companies have massive brands. Why? Because the infrastructure provider captures a tax on every single participant in the ecosystem. You probably know tech companies that launch flashy products but are constantly burning cash to acquire users. They have beautiful marketing, but they have no structural pricing power. Meanwhile, the infrastructure provider quietly generates massive margins by serving every single one of those competitors simultaneously. The difference isn't just luck, it's a relentless focus on the architecture. Analyzing a stock at this level is like a masterclass in developing the right strategic mindset. You learn to distinguish between temporary software trends and permanent hardware realities. You become skilled at looking past the immediate media narrative to find where the true economic gravity lies. Most importantly, you develop the patience to let a massive macro trend play out over years, which is probably the single most valuable skill any investor can learn. Let's talk about what this means for you in practical terms. First, it completely reframes how you view market corrections. Most high-beta technology stocks experience massive drawdowns during their lifetime. With an infrastructure giant, these pullbacks shift from terrifying crises to potential opportunities to study the valuation. Supply chain bottlenecks become manageable risks to track, rather than reasons to panic. You're not ignoring the geopolitical risks or the manufacturing concentration, but you can handle studying them rationally because you understand the underlying demand isn't going away. Market volatility, which is probably the scariest scenario for most casual investors, becomes something you can actually navigate with composure. A long-term horizon gives you the breathing room to let the technology mature. That's enough time to see the real-world deployment of autonomous systems, robotics, and enterprise software, instead of desperately reacting to every single headline that flashes across your screen. And then there's the broader dynamic of how we understand progress. When you're constantly looking at the world through the lens of short-term hype, everything feels chaotic and unpredictable. Having a deep understanding of the structural engines of growth allows you to be more analytical, less reactive, and more objective about where the world is actually going. So there you have it. This isn't just a ticker symbol on a screen or a collection of numbers in a financial report. It's a window into a complete structural transformation of human capability. It changes how industries operate, how capital flows, and how the future is being constructed. If you're currently staring at a market environment that feels overwhelming and impossible to predict, don't panic. Start looking at the bedrock. Focus on the infrastructure. And remember that understanding the fundamental engine of growth is infinitely more valuable than just chasing the noise of the crowd.